So what we're going to look at today is a thing called market risk. Does anybody, so there was a couple of people who said they actually worked in market risk. You there, yeah? What sort of market risk is it? Pardon? I've actually got very bad sign.
I work on fundamental review of trading book.
Oh, a trading book, yeah? I see, very good. And is it foreign exchange or equities or what? Oh, I see, yeah. So that's actually very interesting. And one of the things we're actually going to get to here, yeah, is that there's this kind of movement away from a single kind of risk model across all asset classes, which is a very interesting topic, which is actually the motivation for my talk today or whatever. So market risk is very simply, the risk that you lose money on changes in market rates. So we're going to look at stock indices because they're the easiest to implement. We want to sort of concentrate on improvements, so we're not going to concentrate on implementations. Has anyone ever heard of a thing called value at risk? Yes. So it's nothing to do with Leo Varadkar. No, I guess it's a joke. Yeah. But anyway, I worked somewhere where they used to call it PML, but that financial institution had to be different to everyone else. But what you can describe it as is the currency of risk. And it's defined at a confidence interval and a holding period. Example, VAR 1 day holding period at 95% confidence interval of 100 means that 95% of the time, or 1 day in 20, your losses will be above 100, minus 100. So the point about it is that you can kind of look immediately there. It has to do with you're doing some forecasting because you're kind of predicting, how bad things can get or whatever. The interesting thing about it is that it's usually quoted as a positive number, although it refers to a loss. If you're very pedantic and if you're very, if you're into gameplay and you can actually and kind of contriving things, you can actually come up with, in some circumstances, a portfolio that doesn't lose money that can be put through a VAR model, but that's kind of more a sign that it's a bad VAR model or whatever. So it's a kind of an edge case that's worth if you're that way inclined. Anyway, so one of the VAR kind of emerged in the mid-90s, and I'm actually old enough to say that I was around before this was used or whatever. So I can actually, and that's actually relevant later on or whatever. So it's used to consistently measure disparate products in disparate markets. So one of the delegates here was saying that he works in all the asset classes. So the VAR is kind of like the currency, it's how risky is a position. You don't sort of say it's so many million of a foreign exchange position or it's so many million of an equity position. You sort of say it's VAR of a certain amount or whatever. So it's a kind of, that's why I defined it as a currency or whatever. Now, this is very, in my opinion, a very significant point. The measure of risk frequently changes with changes in volatility. And what I mean is that, say I wanted to take a €100 dollar position, is that the amount of risk, it could be measured at, say, X today or whatever, right? But if the market gets volatile between today and tomorrow, it could be X plus some amount or whatever. So it actually adapts to changes. Now, this is actually very significant kind of systemic issues for a market, is that if everyone is there in the market and the actual risk measure changes, and if they all have the same risk measure, they're all being motivated to do the same thing at the same time, which has kind of got very far-reaching consequences for the sort of stability of the market, which is why the regulators have recently kind of started to motivate banks to diversify their risk models. So that's kind of one of the things I was motivated to do here. So here we are. I thought that was the first slide back or whatever, right? So the VAR we're going to look at today is a thing called a historical VAR. It's just basically take the last years of data. You can take more or less, but if you take less, you haven't got enough samples, and if you take more, you're not getting the current environment, so that's the issue. Do you mind me asking, do you use historical VAR? Sorry.
We use Monaco.
Yes, so which is, so you've got a lot of non-linear positions. You've a lot of option positions. Yeah. Sorry, we're not going to tell you anything. You're not going to tell me anything beyond that, so it's okay. So anyway, so the issue about it is that the historical var, it's incredibly simple. Like you just literally take the returns over the last year and you sort of say, so if I got historical daily returns over the last year, I just apply those to my portfolio, I just rank it, and then I take a percentile. It's as simple as that. Now, the thing about it is that if you were to look in the annual reports of a lot of large banks, you'll see this is what's used. I only looked at one annual report, and I can tell you it's definitely there. So if anybody wants to ask me later on, I'll tell you which bank it is. But it is actually used quite pervasively. It's easy to explain. It's easy to, because I hope I've explained it there, and you'll see it's very easy to implement. There's a couple of lines at Pandas that does it. It's easy to implement. The issue around Monte Carlo simulation is quite difficult in a lot of circumstances, but that's from my experience as well. But sometimes you have to do Monte Carlo, but let's kind of keep to where we are here, right? There's a lot more consistent implementations. If you were to read some of the output from BAL in Switzerland, is that they actually said that they did a study and they gave the same portfolio to a kind of a population of banks, and they said go off and come back with a VAR number, and they were actually astonished with the variety of the figures we're coming back with, and they were all told to use the same methodology. So the point about it is you don't have as much variety with historical VAR as other things. There's a number of different ways you can do Monte Carlo simulation. So when you're there and you're actually looking at comparing VAR across different institutions, it's very good at the at the say bank level anyway to have something like historical simulation, because if you're a regulator or if you're an investor, like you want to compare how risky is this investment bank against that investment bank, etc. So the other thing is just empirically it deals very well with fat tails distributions. Does anybody come across the issue of fat tail distributions in any of their... Is it a well-known term or whatever? Effectively what it means is that the probability of extreme moves is greater than implied by the normal distribution. Now, initially there was a lot of closed form solutions for VAR that assumed normality. That was back in the days when I started in risk, and we thought we were so sophisticated and we were so wrong, But a much more important thing, and it's a very obvious thing, is that correlation bunches under extreme movements. We're interested in, say, the 5% extreme movement. Under those circumstances, what's happening in the market? People are getting rid of their positions. There's indiscriminate selling, or or getting towards that, or whatever. So you actually have correlations increasing. So if you were to actually do a pandas and you were to actually say filter out only changes, say less than 1% and get the correlation, and then get all the population, you would get quite divergent correlation. Changes in correlation. Excuse me. So we finally got to some code. I just want to say we're not writing as functions here or anything, but I just want to sort of get the point across here is that this is the pre-processing. I chose stock indices because they're very, very easy to process, and we can kind of concentrate on improving the model rather than explaining how to implement a model. So there's nothing to it. There's a percentage change there, you see the second last line. So I have a list of 6 stock indices and I'm just getting a percentage change. Now, there is, depending on the asset class, is that you're not always going to use percentage change. For something like interest rates, you should use the absolute change. And why that's important is that usually interest rates don't move a percentage of. So like say interest rates are currently 1%, you're talking about say a 25 basis point change when central banks, changed their policy rate. But that was the very same when we were at 10%. Yeah? So in order to do this correctly, usually you should actually implement the actual changes, the actual level of changes rather than a percentage change. Now, this is for very short-term rates, so like say like your 1 month rate. But this is the kicker here is that when you go further out the curve, like say you have a 30-year rate, is that it begins to behave like stock indices, so you have to have a percentage change. So effectively, if you want a very sophisticated model, you have to kind of blend from one to the other or whatever. So that's just You know, that's just an ideal scenario you should be looking at. So the next thing here is the historical var implementation. There's not much to say. Var periods 250. The positions I have there, I just assume we got €1 or $1 in each of them. So what we do there is that the series historical var is effectively it's an array of the amount in currency, you know, profit or loss. There's 250 entries there, so you know, based on the movements over the last 250 periods. So you see there is that if anyone's familiar with pandas, there's a function called iloc, and effectively it's like a two-dimensional array. So the first dimension, and you kind of slice, is you effectively take slightly over 250 periods back, and you take 250 periods, and then what happens, you're coming down here, and so your historical var is you just used a percentile of that. And the next thing is your hypothetical P&L, which is like calculating the historical P&L var, but you only take today's profit and loss. So that's the profit, and you're actually sort of then testing, does that stay above the P&L? So you would expect the hypothetical P&L to be a larger negative number 1 in 20 times if you're using 5 percentile. Is that clear? Do you want me to go through it again, or to say yes, no, maybe? Didn't hear anything, so. But anyway, so just to sort of reiterate, what we're doing here is that if, like, say we were doing it for 3 days, and the first day was, say, minus 1%, the second day was plus 2%, and the third day was plus 0.5%. So all we're doing is we're just taking our positions and we're multiplying it by those 3 numbers. And then we're just sort of getting a percentile. And that's our var. And then what happens, the next day we're getting, well, what's the P&L? Because at the end of that third day is, you know, they're 3 days back from today or whatever. So effectively that's all, you know, the historical var is or whatever. Now, in practice, what happens is that you'd wonder why am I using this hypothetical P&L? It's there's a number of, it can be called clean P&L, and what it is, it's that you just take your position, your closing position on a particular date, and you apply what's happened today to that position. Now, you might sort of say, well, why don't you use an actual P&L? That would be slightly different than the actual P&L that your traders make that day. And why it's slightly different is that, I think what happens is that, say last night, is that I had a position, and throughout the day I initiate new positions, I close out positions. So you're getting, if you include that in your kind of testing of your var, you're going to actually create noise which you don't want or whatever. So that's just the distinction between actual P&L and hypothetical P&L. So the procedure is that hypothetical P&L is compared to var every day, and whether breach, if it breaches, you record it as a 1, if it doesn't breach, you record it as a 0. And usually these models are tested once a year, so you have about 250 observations. There is requirements under certain circumstances that you do this for the regulators, you know, but that depends on whether, you know, you're using this to calculate capital or whatever. So the thing you want to sort of test is that if I say it's 5 percentile, you know, does it breach 5% of the time? Now, it's no good to sort of say, oh, it only breaches, say, 1% of the time, because that's a bad model as well, because you're overestimating risk. So you want it to be around 5%. So that's what the Kupiec testing does. And the second thing is the Christopherson test, which testing for runs of breaches. So you want to penalize a model where there's runs of breaches. Yeah, so that's something that you know, you want the breaches to be independent of each other. So that's what that does. Now, we're not actually, I'll show you the code in the next slide. We're not actually going to use these because there's a much better method to actually do this. And why there's a better method is that this only kind of tests 2 things, but var is much more than that. So if you want to actually improve it, you need to do other things or whatever, yeah? And the final thing I'm going to say is that test portfolios are used to improve test coverage. We'll come on to that later on. So here's the Kupiect and the actual Christopherson serial independence functions. You see here is that, I suppose the second function is the one that's obvious, is that you see here is like you're creating running totals there that increase if there are successive breaches or whatever, you know. So there's not a lot to say about that, but if you're ever doing testing, these are the two things to do. And I actually worked, well, relatively recently in, well, it was 2012, which is recent for me or whatever, in a model risk department, and these are the tests that you would actually run on the models. Although to actually call a historical var a model is a bit of a stretch because there's no parameters in it, you know. So you know it's the only parameter is like how far back in time do you look or whatever. So, so the thing is that here we're going to very soon we're going to get to some sklearn code or whatever, right? So this historical var, like we want to actually improve it, and remember what we're doing. We're actually looking back a fixed length of time. So we're just sort of saying we are only going to look back a year or whatever, right? Now, the motivation to actually look for something to improve it is that, you know, is that correct, or should we have a selective view of you know, the past? And what I mean by that is that does the market go from kind of state to state, you know, and alternate between those states? And like obviously I think it does, and whether that's correct or not I don't know or whatever, but like the ultimate thing is to sort of test it, which we will get onto later on or whatever. But there is, let's kind of get out of specifics for say individual markets, because that's, you know, you could like there's things in the stock market which is like the January effect, you know, certain things happen in January or whatever, and there's day of the week effects, like, you know, it's empirically been proved that depending on what day of the week it is, the stock market behaves differently or whatever. So, you know, if you're looking at your risk for a Wednesday, maybe you should only look at Wednesdays in the past, or if you're looking for January or whatever. But the point about it is that that's the whole motivation here. So I hope what you know, everyone can see here, although I'm not always very obvious, is that what we need to do is we need to sort of possibly increase the size of the window and cluster within the window, and then selectively figure out what cluster we're currently in, and then only take from that cluster, if that makes sense or whatever. So to give you a very simple example, imagine we come up with a model, and our model says January is different than any other month. So we have two clusters, January and not January. So effectively our model would sort of say, okay, is it January? We'll take from the January cluster. If it's not January, we'll take from the other cluster. So effectively that's it. So the actual implementation, it's all in the parameters. Sorry, there's just one thing to sort of say. The clusters can obviously come from two things, is that we can derive it from the risk factors, and our risk factors are the indices or whatever, or we can take external or calendar based information. Now, we're only going to derive attributes from the risk factors here, so we're actually going to take our stock indices and derive some risk factors from that. And the external and calendar is kind of very domain specific, and you know, we're not going to gain a lot by actually going into domain specific data here. So like I think I mentioned already, there is a thing like a January effect in the stock market apparently, although I haven't read about it recently, and the day of the week as well, you know. But let's just go through it now. What I'm going to do is I'm going to use, does anyone look at Bloomberg or CNBC? Do you ever notice that they always have charts, yeah? And in odd times they'll have somebody called a technical analysis, and they sort of say, there's support and resistance, you know, and stuff like that. This is all the language of a thing called charting or technical analysis, and it's basically using the historical time series to sort of, you know, forecast what's going to happen or whatever. And I actually worked at this for a while. It's like it's kind of it's like Marmite. You either like it or you don't. And I like Marmite and I like technical analysis. But the point about it is that it's used to actually, you know, categorize the market. You can categorize it as a bull or a bear market or a neutral market high volatility, low volatility, all these things or whatever. So I just use that, and it's also the vernacular of the market. So you're talking in the language that is somebody who's a manager in a bank or whatever would know. So I'm going to tell you now. Here's some pretty compact code. Oh no, it's not. The next one. So what we're working out is the ratio of 30, 50, and 200-day moving averages. So these are moving averages that are used in technical analysis, and then so it's the actual closing level of the index against the moving average. And usually what happens is that if the index is above it, it's in a bull market, and if it's below it, it's in a bear market. A slight variant to that is the ratio of two averages. Then there's the ratio of two standard deviations. Then there's the ratio of how many standard deviations the current stock index is against an average. And it's, as you get, that's quite a useful thing, and it's used in a thing called moving average convergence, divergence, if you want to look it up or whatever. So here's the actual code. So there's a lot of just sort of going through all the indices, going through all the different dates or whatever. A lot of it is done automatically by pandas. There's, you have to pass through it a few times, because what happens is that, I actually forget why you have to pass through it a few times, but I haven't got it up on GitHub at the moment, but I will put it up if anybody's interested. There's not a lot of implementation. It's very easy to figure out what's going on with this. So effectively what we're doing is we're taking our data frame and we're just sort of adding a lot of columns to it. And what I did then was, so here's the next thing is that, so there are attributes. So effectively where the attributes the attributes are going into the k-means, which is one of the, if you kind of look there, X, yeah, there's our cluster attributes. Yeah, we take the data frame, and we actually get what are the attributes we've actually calculated, and we scale those because they're at different scales or whatever, and we just basically, I just assume 3 clusters. This is something that can be tested. I just sent it into k-means, fitted it, and then I just got my cluster label. And then I just selected from the cluster label that's similar to the most recent cluster label. Now, the important thing is that the clusters sizes aren't always the same. So the size of the window has to be, if we're using 3 clusters, and say previously our historical simulation had 250 observations, is that we have to use something over 750. So that's just something you have to do here. So the point about it is that you might have over 250 observations, so you just have to take the most recent 250. So that's just an implementation detail. Now, comparing results to historical var, I take a very crude measure here, is that I don't bother about those 2 tests I talked about earlier on. I just compare the absolute deviation from the percentile against the same number for the historical var. So what you do is you just sort of say, well, how many breaches was there in the historical var? Divide that by the number of periods. Do the same for our, improved model, and just get and I do that by year, and I actually use 15 years of data. Why I use 15 years is that the first time I actually talked to someone about this was 15 years ago, so it's only recently I've implemented it or whatever. So, but I wanted to get a kind of the same length of time before and after the financial crisis, because the point about it is that the stock market and a lot of markets are kind of in a different kind of character or whatever. So in order to be kind of confident that you're getting something that's worthwhile, you need to kind of look before and after. Now, this is important. We perform this not just for, now just one thing, I actually looked for historical holdings from, say like things like unit trusts and stuff like that. It's not possible to get that unless you have, it's possible to get it for closed-end funds and stuff like that, but I need a Bloomberg, and I don't have one down in Laois or whatever. So effectively, I had to come up with a number of different portfolios. So what I did was I actually used the following. I came up with a trading strategy, and I created 4 different types of portfolio. So I just went through time and I sort of said, okay, here's my decision kind of rule or whatever, and I just effectively the portfolio was varied every day. Very basically, the long portfolio is something that kind of follows the trend. The short one goes against the trend. It's not very good naming, I take it. Spread is that you kind of do that, but you kind of hedge it, you know, with the stuff that's underperforming or whatever. And so the spread one is equivalent to the long, and the spread 2 is equivalent to the short. So it is just, you're just sort of hedging your bets slightly or whatever. So these are neither here nor there. But the interesting thing is that spread is kind of more like investment managers, people who manage your pension and stuff like that, whereas short and long is kind of more like hedge funds or banks or whatever. But you know, you could actually make them more like it or whatever. But what we want to kind of demonstrate here is that the actual performance of models depends on the trading style as well, not just on the asset class. So there's a lot of things to consider, you know, to sort of say what is the correct model you should use or whatever. Yeah. So here's the results. So it's just basically a yes if this model outperformed historical VAR, and a no if it didn't. And you see, the interesting thing here is, look at the very last row, is that these are kind of bank-like positions, is that it was very, you know, it seems to have outperformed in the majority of instances. In the second things, which are kind of more like investment managers, it was less certain or whatever, right? And also it kind of varied slightly through time. Now, the parameters I used, I just did a random search. It was the S&P 200-day moving average, yeah, against the current index, the ratio of that to the NASDAQ standard deviation 50-day as opposed to 200-day. So if you actually go through the code, you'll kind of see what those figures are. So, like, to summarize, the results vary by portfolio type. This allows for model diversification because there's a phenomenal amount of parameters you can use to actually do your kind of clusters. So you can actually diversify your model. So that's quite important because the regulators are now encouraging banks to kind of use different trading models for different desks. Because they kind of accept that it is dangerous to actually use the same model across everything, because it kind of, any bit of thought will sort of say it doesn't make sense, because effectively seasonality varies very considerably between different markets. Like I was actually talking to someone at lunch who works in ESB, and you know, there's seasonality in that market, you know, because obviously the you know, the demand for electricity is, you know, it's more variable different times of the year. Like, to give you an example, when it's during the winter, it's much more variable because, you know, the weather varies a lot more during the winter or whatever, you know. And also, like commodities, you know, the harvesting season is a time when there's an awful lot of uncertainty or whatever. Also, say frost season and stuff like that. And like, you know, and also, like, say in stock markets, you know, there's seasonality in earning season or whatever, you know. Like, it's pretty, like, results don't come out every single day of the year, like, they're different days of the year or whatever. So you've got all these disparities, and like regulators in the past to sort of say one size fits all or whatever, and it's just, it doesn't make any sense at all. So I think there's some benefit here in that you actually do allow for model diversification. Now, if I was to start this talk again, I'd actually talk about this third point more than anything else. And what this is that, remember I said that VAR actually, say I was trading today and we had a very volatile day, my risk charge would increase tomorrow. Yeah? Now, that's kind of a fundamental shift than, you know, what used to happen before. Before, what used to happen is that, like, say you were managing a set of traders, you'd sort of say, this is your risk, you're allowed to take so much currency amount of a currency or whatever, or say a stock index. Whereas now the model actually determines that. This thing of kind of changing it very, very frequently is again dangerous. It's, or personally, this is very opinionated here, right? But it is a dangerous practice or whatever. You got to think that if you're working on clusters, you're going to have less frequent changes, but kind of larger changes. So you're kind of going back to where you were. And the only thing I'll say is that, you know, the existential threats we've faced are kind of, okay, so it might be a terrible coincidence, but like, you know, things have got worse since we've brought in a lot of these models or whatever. And I think there has been an acceptance by financial regulators that, you know, it's no harm kind of investigating at least this diversification of models. Now, that's again very opinionated, but you know, I am an opinionated person. Now, the next thing is that much more sophisticated selection criteria required in practice that include a comprehensive measure of using a VAR model. So, what I mean by this is that the two tests I mentioned, they kind of measure how close are you to actually your percentile or your confidence interval, and also what's the measure of runs or runs of breaches. So, but there's other kind of, if you like, costs of running a VAR model. The most obvious cost is that if you're actually changing your price of risk on a daily basis, is that you might be forcing the business to actually liquidate positions because they're running against their upper limits of how much risk they can take. So that's actually a cost. The second thing is that if you have a lot of runs of, you know, losses, you know, you might have to call on additional capital under stress scenarios, which can be expensive. So effectively what you need a very sophisticated or comprehensive kind of fitness function rather than just two hypothesis tests that follow the choice square distribution. So again, this is very opinionated. The next thing is that you'd probably need to include static portfolios. Like obviously there's an issue about overfitting. There's a phenomenal amount of parameters you have here. I don't know. I think one of the issues is that I like models that are very stable. You know, I look for a model rather than being as close as possible to the confidence interval. I'm running out of time here, so I can see. Rather than having a model that stays very close to the confidence interval, I'd kind of edge towards going towards a model that gives me very much around the same percentage every year, although it might be slightly further away. It's just, I found that from kind of constructing trading models, you know, look for, it's just a personal opinion again. And the final thing is that, which is I like as well, is combining models. So at the moment we just sort of take it yes or no, are we going to include it? But if we combine models, we actually apply a weighting, you know, to individual historical observations. So so it's just a thought or whatever. So how are we doing for time? Because there's actually a few other slides that haven't to do specifically with this, but it's just kind of other things that if you're working in a bank or whatever, you know, you could actually use sklearn for. Pardon?
10 more minutes.
10 more minutes, yeah. Or do you want 10 more minutes overall, or 10 more minutes until I go to questions? All right, I need to get out of here. Wrap up. Yeah, very quick. What I'm going to say is that use decision trees to explain VAR breaches. Yeah. Use regression to identify positions in portfolio. And has anybody ever used a thing called elastic net? No? I never heard of it until yesterday, but it's effectively lasso. Effectively what you're doing is that, you know, you can actually deduce what your positions are, and you can reduce them down to a sort of a thing. And the final thing is stress testing. So what happens here is that things like anomaly detection, and there's something, effectively you train the model to sort of say what's, you know, a novelty or an anomaly detection. Sometimes when you do stress tests, you create a state of the world that is impossible. So if you have all the states of the world in the past and you actually put that into a model, you can put that in to sort of accept or reject it, whether it should be allowed to be used as a stress test or whatever, yeah. So effectively, that's it. I thought it was under time, but I just don't know. But I suppose when you're up here, it's different.